Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Giles Gale, Head of European Rate Strategy. And if you're worried about why Imogen isn't leading off today, fear not, because I'm joined today by our global market specialists, Imogen Bachra and Jan Nevruzi. And before we continue, I just want to remind everyone that you can pose questions to us by reaching out to us at bondcast@natwest.com. Okay, so Imogen, you're first because today was the Bank of England day. And what I want to know is what we have learned. So how does everything alter our expectations for policy going forwards?
Yeah, it was an interesting meeting today. I think they delivered on the 25 basis point hike as we expected. And actually that was with quite a hawkish shift in the vote. So the vote was 6-3, 6 for a 25 basis point hike, but 3 for a bigger hike, a 50 basis point hike. Whereas we had penciled in, perhaps a dovish skew to the vote, 7-2. So on a headline, that appears to be a kind of hawkish delivery, but actually on all the other elements, the Bank of England was much more dovish, we think. So this was a monetary policy report meeting. So we got updated forecasts for both inflation and for growth. Inflation in the near term was revised up, but their inflation forecasts over the longer term, and particularly the 3-year point, were revised down quite significantly. That went from 1.6 to 1.3. So what the bank's telling you there is that with the current market pricing, or the market pricing that was current prior to the meeting, they're implying that inflation over that 3-year horizon will get to 1.3%. Growth was also revised down lower, not a significant change in this year, but over the 2-year and 3-year horizon, that was, the year-on-year rate was essentially very small negative and then very small positive, so sort of stagnating growth over the next couple of years. The guidance around further tightening was also slightly diluted versus the last forecast round. So they had revised that down already to further tightening likely being required. So the committee judging that further tightening may be required. And this is now not all the committee, but only some committee members think that some further modest tightening might still likely be required. So a little bit of a dilution there, I would say, in terms of what tightening we're to get. And then the final element that, was in line with our expectations, but we probably sat at the dovish end of expectations, was on quantitative tightening. The guidance was that they would be now kind of starting the preparatory work, setting the working groups in place, perhaps a more formal consultation process with investors. That would take place between now and August. In August, they will report back to us their findings, but they won't decide on whether, and that's important, not just about when, but whether to begin active gilt sales until a subsequent meeting. So gilt sales will not begin before August, essentially, or even at August meeting. That's kind of in line with our expectations that we wouldn't get an announcement on active sales until Q4 of this year, and they wouldn't be beginning until 2023. So a hawkish sort of headline delivery, but actually on all other elements, and certainly around future tightening, quite dovish.
And that's really the way that the markets took it, right? Certainly the first move was to take this very, very dovishly, and actually we've had an exceptionally volatile day because just before we record, markets are roaring back in the other direction. But if we take this, overall, do you consider that the dovish knee jerk, is that the right one?
Yeah, I think so. You're right. The knee-jerk reaction was particularly dovish. Markets are priced out, a kind of full 25 basis point hike over the next sort of 6 months, let's say. We're seeing, one year rally again, like 25 basis points. So it was a significantly dovish reaction led by the front end, which I think that was the right one. We've been saying for some time, on this podcast as well, that we've increasingly been feeling like market pricing has become detached from the Bank of England's guidance. And today just really reinforced that message, I think. There was nothing about, we've been talking for a while how we only see one additional rate hike now this year. So we had May, which we've just been delivered today, and then August penciled in. And our risk case was that we might see 2 additional hikes next year after a pause after August. But there was really nothing about today that made us think that that risk case has become any more likely. So we haven't updated our base case. We still see just 1 additional 25 basis point hike this year, which we think fits with the bank's guidance and what was, what they told us today. But markets are still detached from that. So there was already, repricing to be done, but I think that there's still further to go. So we, the trades that we've been talking about going into this, just being like received 1 year, or receiving 1 year versus being short gilts further up the curve, or receiving front dated kind of August or September MPC SONIA, still look super attractive to us. We still sit on the more dovish end of market expectations and think that there's a lot more still to be priced out in terms of bank rate pricing.
Okay, thanks very much, Imogen. We're going to go over to the US now with Jan, because it's been a super busy central bank week, and last night we had the Fed. What have we learned there? And well, I suppose, how did that compare to the very, let's say, hawkish expectations into that?
All right, so the Fed delivered exactly what they pretty much promised. We got the 50 basis point hike, the first one since the 2000s and the early 2000s. And we also got the announcement of quantitative tightening, which they're going to start June 1st and ramp up to 95 billion across treasuries and mortgage-backed securities, 60 billion in treasuries, 35 in MBS. Within 3 months. So that's a quite fast of a scale up in pace. It's also almost double the 50 billion runoff pace, which we had during the last quantitative tightening a couple of years ago. As far as rate hikes go, Powell, they delivered 50 basis points as was more or less priced in, but really the question was a bit forward looking. Were they going to commit to 75 basis points or no? As was our expectation, Powell poured cold water on that, basically saying there's really no need. 50 basis point is a fast enough pace, and we're not actively considering at this stage a 75 basis point hike. Fair enough, but looking at the next couple of meetings, it looks like 50 basis points are like the firm standard, which is kind of what we expect as well. We have at NatWest Markets, our forecasts are for 50 in June, July, May, June, July now, and then we have 25 for the remaining meetings in this year, which is more or less the message that we got. However, the rest of the press conference was pretty hawkish in our view. It didn't really kind of back off from the need to tighten. Even from the get-go, he was very kind of apologetic about the impacts of inflation on the average economic citizen, and pretty much saying that he understands that these rate hikes are going to be tough. And of course, it's easy to see the sympathy in that inflation is very hard. It is very hard on the entire consumer base. But that being said, everything seems to be on track, and we kind of feel like this is the peak hawkishness for market pricing.
Okay, so building on that thought then, peak hawkishness for market pricing, you already sort of lent bullish, was that 2 weeks ago? How does this leave your rates views, so longer term?
Yeah, so with the peak hawkishness, our idea is that markets are pretty accurately priced in on what the Fed's going to deliver. That being said, that kind of the risks are pretty symmetric on the curve for the very, very near term, which means that for the next 3 months until the September meeting where we think the pace could slow down, until then, if anything, odds for a larger hike are probably greater than a smaller one. So we're not going to rush and try to be long twos, as you could kind of see like another shift higher in yields there. But that being said, if the market is priced to kind of call it perfection in the front end, and if we get exactly what's delivered, the next thing to look out for will be the demand side. So can the economy handle all these hikes? Can the economy handle rates at above neutral rate? We're not saying the economy necessarily cannot. It's just that when we took the risk of balance between inflation, which might slow down, and demand also slow down, you kind of see this outperformance of the long end as well. We have a little bit more certainty about the path of the Fed, and as some economic indicators are already showing slowdown in demand. We don't buy into the recession story, but we do buy into the fact that the Fed is hiking in the face of slowing demand. So with that, we're now more comfortable suggesting entering into like a full size, because long intense. Before the FOMC meeting, we had kind of started scaling into it, and now we suggest kind of adding the last portion at the 3% level today.
Okay, so full conviction on US rates then. Fine. So, okay, in addition to the Fed, I think it was just before the meeting, wasn't it? There was the very technical but important event of the refunding announcement from the Treasury. So maybe you can just run through the key takeaways from that for us.
Yeah, well, with the very technical, I got the cue. Keep it short.
Not at all.
Of course, very quickly. This was perhaps the last cut since Treasury's large issuance announcements after the COVID shock, which required the need for larger financing. We got pretty much in line what we expected with the small tweak in 7s and 20s. We had 1 billion cuts across all nominal coupons and 3 in 20s. What we got was more 2 billion in 7s, 2 billion in 20s, and everything else was reduced by 1 billion. Tip sizes were increased, not because necessarily we don't think that the market needs more tips auction sizes, but Treasury wants to maintain the percentage of tips as marketable debt at at least a stable level, and that's exactly what happened. We got 1 billion in the 10-year tips, 1 billion in the 5-year tips. And a large portion of this, where we differed from a lot of consensus views or generally like the TBAC's previous recommended financing, was due to our view is that Omicron did not really impact activity as much as it was feared early on. And the tax receipts in April were exceptionally strong, as we kind of touched upon last week. And the trend continued, very, very strong cash inflows to the Treasury, which kind of took away a little bit of the pressure to immediately continue overfunding themselves. And it looks like the Treasury is in a pretty good spot to handle QT, which will directly flow through their balance sheet as they have to repay more debt to the Fed and kind of finance in the privately held marketable debt. So I guess that's it. We got reductions more or less in line with what we expected, increases in tips more or less in line with what we expected. I'll look forward for more reduction in bill auction sizes. There's going to be a new benchmark coming at the August refunding, the 4-month one. There's been strong reception for that. There's clearly demand for bills. And in the meantime, we were looking for bills staying rich against the OIS, just purely out of their scarcity value.
All right, thank you, Jan. I guess with that, we can move over to Europe then. We obviously had the Fed and the Bank of England in their blackout period or quiet period, I think they officially call it, last week, which meant that but the ECB was pretty quiet too, but obviously not wanting to be left behind this week when we're getting updated guidance from everyone else. We've had a pretty active week for ECB speakers, and I guess they've been kind of shifting the needle really on policy direction. So what have we learned, and how is your view, I suppose, on the ECB evolving as a result of everything we've heard this week?
Well, I think, to be honest with you, you overstated a little bit, Imogen, with this idea that they're shifting the needle on policy guidance. But the needle is shifting a little bit, right? I mean, we've had 3 reasonably important speakers this week, all from the executive board. So Isabel Schnabel is she has been leaning more hawkish recently, and I would describe her as kind of the bellwether for hawkish sentiment. And essentially what she said, in so many words, in far more words than this, was that she thinks that July ought to be our base case for a rate hike. I think, I mean, reading between the lines, you'd never say it quite like that, but assuming that there isn't a pretty significant fall off in economic activity, and that things sort of more or less track as expected. And so that's a fairly big if, to be honest with you, given the uncertainties from what's happening in Eastern Europe and China, these major uncertainties that we know all about and have discussed at length on previous podcasts. But assuming things track in line, we should be looking at a July rate hike from her perspective, I think. Lane was a little bit more circumspect. I mean, to be honest with you, he didn't really express much of a view in a speech that he gave today. It was one of these lengthy sort of surveys of the data and so on. A lot of, on the one hand, on the other hand, a lot of recognition of higher inflation expectations in particular, particularly from businesses and households and so on. So, I would say a little bit of a shift from him, but no strong conclusions. I think still in the spirit of keeping optionality on their side. And then Panetta, who is at the dovish extreme, he was just I guess he was really going back to the slower Q1 growth and the slower hard data overall. And I think that's one of the things that we're all grappling with, really, is that the hard data is pointing to more weakness than some of the surveys that have been coming out more recently, and arguably maybe a little bit more timely, a little bit more forward looking. So let's see what wins out there.
Moving on, I guess, to what this means for markets then, we're off the desk, so we don't know what exactly they're doing now, but you made reference earlier to the fact that, gilt yields and UK market was rallying quite significantly, and that kind of spilled over into Europe as well. And, on the day, rates and yields were still lower when we left. But it's been, I guess, a symbolic week this week for fixed income globally. We've hit this kind of 1% in bonds, 2% in gilts, and 3% in treasuries. And regular listeners and readers will know that 1% target in 10-year bonds, well, that has been our target for some time. So how are you thinking about bonds from here, I guess, with the evolving message from the ECB and everything else that's going on in the world?
Yeah, listen, I mean, I can't listen to you telling us that the Bank of England is sort of maybe leaning or confirming a slightly more dovish tilt compared to what the market has in mind, and Jan essentially saying similar about the Fed, without at least being a little bit cautious about just saying, oh, the risks are clearly skewed to an ongoing sell-off in Europe. And alongside that, I'm also very aware that the front end, at least it's moved a lot this morning. Actually, this morning I think that we were, if you consider essentially two possible outcomes in the market's mind, either 3 hikes or 4 hikes this year. I mean, both very very hawkish expectations, in my opinion. The market this morning was leaning pretty heavily towards the 4 hike version of those two scenarios. Something like 60% priced in for that. That's actually moved back quite a bit. I'd have to check. But listen, I think we're probably more like 2 or maybe with risks of 3. And so again, it's difficult to be max bearish on longer term rates when you have this more kind of constructive view at the front end. But that again has been the way that we've been playing it for quite a while. I actually think that the shift in the ECB may still be something which can continue to build into the summer. So that's one thing. I'm also, I also think that it's important that the ECB, for example, has been actually pretty supportive for the market through its gross asset purchases, which in the short term are really what matter. It's not net asset purchases that we should really be focusing on, again, in the short term. And that's something that won't be sustained at quite such a strong pace. I look at the the data on the survey side and some of the details on inflation, they all look reasonably robust and sort of point to a continuation of the high inflation theme. I think that fiscal slippage and the fact that quite a few governments are already sort of behind their usual sort of rhythm for this point in the year, so they'll have to presumably do some catch up a little bit later. Now, I can still see lots of bearish arguments, basically. Of course, valuations matter, but our models have always suggested that the risks are on the upside of 1% in Bund, and that is still the way that I am biased.
Yeah. So I guess away from core rates, then the other kind of symbolic level that was reached in European fixed income was in Italy. They also, well, I don't know if it closed above, but certainly touched 3% in 10-year BTP yields. And that put the spread of 10-year BTPs over bonds at 200 basis points. So inevitably, we're starting to get more and more questions from clients around, this kind of age-old question about the risks of debt sustainability in Italy, and particularly now in light of the ECB stepping away. How does your assessment of the kind of debt sustainability risks for Italy look from here? And are investors right to be worried that this is a major risk for BTPs?
Okay, so this is something that always comes up whenever BTPs are widening aggressively, and I think it's something honestly which is overplayed. If you look seriously at the debt sustainability analyses, I think you have to be pretty aggressive to see the debt to GDP ratio widen dramatically. I mean, clearly it could in a recession, if we have a recession later this year or next year, and but then I think your base case would still be that it would just stabilize at a higher level, say low 160 sort of percent sort of area. And presumably in that sort of environment, you would expect the ECB to come back and support the market overall via more accommodative policy and potentially a restart of quantitative easing as well. On the other hand, I think if you ask the question slightly differently and pose it as what sort of level could be problem for Italy, then I think then what you would say, okay, well, I mean, the kind of standard steady state kind of analysis suggests that if you assume that over the long term Italian growth, maybe real growth, maybe stabilizes at just above 1% annualized, I think that's feasible. And that inflation were to return to, say, 1.75%, something a little bit below the ECB's target, because there's an ongoing need for Italy to kind of competitively disinflate and regain a little bit of competitiveness vis-a-vis Germany in particular. Obviously, that was one of the big themes of the last 20 years, going in the other direction. Then, really, if we were to move to something like 4% for long-term Italian yields, then you might start to have a problem, because you would be asking Italy to be running a primary surplus of in excess of 1% over the long term, and I think that is really sustained. But it is important, and I'll just end on this point. It is important to realize that Italy's total cost of debt is relatively low. It's sort of 2.75 percentage points, something like that across the whole mix. Reduced further by the fact that so much of it is held by the Eurosystem anyway, and now that portion will become more expensive as the ECB starts to raise rates. But the market component of this will only filter in reasonably slowly because remember, Italy's average life of bond debt is over 8 years, and so that would only work its way in reasonably slowly. So I don't think that we're panicking at this point by any means, but I do think that we're getting to the sorts of levels where the ECB might reasonably say, 200 basis points higher funding costs for the Italian government, that has a consequence for the way that mortgages are priced and Italian loans are priced. This is financial fragmentation. Maybe we should be actually doing something about that rather than just talking about it. And I'd say, going back to the ECB communication that we've had this week, there hasn't been anything concrete on that, just the usual promises that, we can do more. But I think that they might need to start being a little bit more specific.
Okay, something to watch out for then. But I'm glad you're not as worried as perhaps other investors might be.
If you like today's episode, even allowing for the switcheroo on the lead off and sign off, please hit the like button to show your appreciation, and click subscribe so that you can listen to our latest episodes as soon as they're available. Thanks again, and see you next week.